All right. Ba, 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 ba. Open the doors, let everybody enter. And Lori, thanks for sponsoring the sandwiches. Do appreciate that. Good deal. Lori and I are the only ones without a blurred or fake background. I got all these little dragons back here that I won in the core. So those
What is that
those
for?
are so the core training, you're basically coached with 11 other lenders and they're all killers. I mean, you're being coached with the best of the best. So every semester the coach will decide who the best student is of the 12. So those things are hard to come by. So
You're the Dragon
yeah,
Slayer.
Good job.
yeah.
You're the Dragon Slayer.
Yeah, they're hard to come by. So I've gotten 3 out of the last 4 semesters I've won, which is good. I won't win this semester because I'm in with some guys that are they're just beasts. So really, really big time producers. So all right.
Hey, don't sell yourself short.
One of my coach alone got 17 contracts last week. So yeah, these guys are all top producers. So
Wow.
but it's okay. Rise to the occasion. I saw Linda Dressler raised her hand. So
Hi, Linda.
hello, Linda. There you go. She's trying to say, "Oh, thanks for the lunch. She got the lunch." There you go. Tony wants that dragon. There you go. Yeah, she helps. She helps. But my coach pretty much already told us who's going to win, and it's not me. So anyway, we're going to get started. It's 11:59. I'm really excited here. We're going to give you guys the format as everybody's kind of checking into the room. I guess it's a little early. I should probably wait a minute or so. I do want to get Lori on her way. So yeah, people checking in. Okay, good deal. Tawana, hello, Tawana. And you guys can communicate with us via the chat. That's going to be the best place to communicate with us. It looks like we do have some folks that are in the Q&A. I'll have both windows open over to the side. So hello, Elena. Been talking about your place for a while. So lunch sponsor today is Lori Amato with Choice Home Warranty. Woohoo! So a lot of people know Lori. Karen thanks you for lunch. Hello, Donna. And perfect, I got that. So as you guys are checking in, we're going to get things kicked off because we got a lot to cover today. My name is Richard Kimball with Cross Country Mortgage. We are very happy to be doing our lunch and learns for you guys, and we're also happy to announce that we're going to be going live with these presentations next month. We've had some people say we want to be in the room, we want to come up to the speakers, ask them questions afterwards. So we will be going live. Linda might have been one of those people that asked about it being live. So we'll talk to you guys about that more at the end of the session. In the meantime, we try to bring you guys a lot of resources that can help you as agents sell more real estate. This topic today is going to help you if you're an investor or if you work with real estate investors. We're going to cover a lot of tax strategies, which are really important, and we'll get into all of our brilliant tax people. But first, we got to start with Lori, who, again, we thank you for the sandwiches. And Lori, can you tell us a little bit about Choice Home Warranty? And her contact information is in the chat. All yours, Lori.
Thank you, Rich. Hi, everyone. So great to see you. Glad you're enjoying the sandwiches. I might go get a Jimmy John's myself after this. But I don't work for Jimmy John's, so please send me some business. I am happy to sponsor these events, and I am so excited that you're going to be live. That's awesome. So transaction fallout is at an all-time high. None of us want that. That affects all of us. You know, it trickles down. So one thing that I can help with transaction fallout is Choice Home Warranty helps alleviate costs. So we make home ownership more affordable. I'll give you I'm known as True Story Lori if you're a Facebook friend. My brother, of course, has a choice home warranty. His furnace went out. We replaced his furnace. He paid about $1,000 out of pocket, got a brand new furnace. He was out in his driveway talking to his neighbor, and his neighbor came out and said, "Oh, I just had to replace my furnace. It was $8,000. And my brother said, "Whoo, you should have met my sister before that, because I just got a new furnace and it was only 1,000." So you guys, people need us. People need us. You need to be telling your sellers and buyers that a choice home warranty is available to them. Let them make the choice. You shouldn't be choosing the home warranty company for them, or you shouldn't be choosing whether they know about it or not. Everybody should know about a home warranty. Everybody needs to save money right now. So we have a 5-year warranty besides our 1-year, 2-year, 3-year. And the way that I have agents using the 5-year is if a home is older and it might make the buyer nervous about buying an older home, even though everything is still working. I've actually helped an agent save a deal. The buyer was going to walk away, and the agent said, "Hey, Lori, I remember you talking about that 5-year warranty. How does that work?" And they went back to their buyer, said, "Hey, everything's in good working order. I know the furnace is 30 years old, but if we give you this 5-year home warranty, would you close on the deal?" Well, they went to closing. So
Nice.
that's one thing that we can help with. We have a veteran first responder discount. The homeowner can rekey up to 6 locks in their home right after closing for only our $75 low service fee. I have video content that I can share with you that you can share with your clients that is education on like how to clean your furnace, how to maintain equipment. So I have that available if you want it. Please send me home warranties. Only me, myself, or you can order the home warranty for your clients. They cannot go online and get our real estate plan. So make sure if you're referring clients to me that you stress them, call Lori directly. Do not go online. It's a different plan. It's our consumer division. It has less coverage. It has a higher service fee, and it has a 30-day wait. None of that applies to our real estate plan. So I would love to talk to you one-on-one. We have limited time here, so I really appreciate you guys listening to me. And if you can send me some business, please send me some business.
And Lori, we don't often get questions for our sponsor, but Tawana asked, can she get a home warranty for a multi-unit property?
Yes, of course, we cover 2, 3, and 4 units. Usually anything over 4 units is considered commercial, but yes, and we cover mobile homes. A lot of home warranty companies do not cover mobile homes. So,
Nice.
and we cover homes over 10,000 square feet. A lot of home warranty companies won't do that either.
Nice. Okay, good. Well, thank you very much. Lori's information is in the chat. She has to go. She's got a little bit of a thing she's got to take care of. But that being said, thank you so much, Lori. We appreciate you and appreciate everything that you do for us. We will talk today or tomorrow. Let us know how everything goes, okay?
Okay, sounds good. Thank you guys. Have a great day.
Thanks, Lori. All right, next up we have Tina Pashovich, and Tina is with Old Republic Title specifically. Actually, it's Old Republic Exchange, and Exchange because it's the 1031 Exchange Group. And we've had Tina on here last year. I personally think she's brilliant, and I think if you guys have questions on 1031s, you're going to get them all answered. We did get a handful of questions when you guys registered. I'll get those to Tina at the end if they aren't answered in her presentation. But her information is also in the chat where you guys will be able to ask questions as we go. Tina, I turn it over to you.
Thank you so much, Richard. I'm going to go ahead and pull up my slide deck. And bear with me here.
So little blurry on our end. Is it blurry on your end too?
Yeah, I'm gonna stop share and then try again because that did not work. Hold on, gotta love these technical difficulties here. Here we go. Let's try this again. We're gonna share this.
Ooh.
What is the problem here? So sorry, everyone. It's up and then I see a Zoom picture, so.
It's all good. In the meantime, while you're working on that, Tina, I also want to let you guys know about who else we have today. One of the gentlemen that doesn't have us. Oh, there you go. Looks good.
There we go.
Yeah. I'm going to introduce our other two folks, though. We have a second here. We do have Dave Mitchell, who will be presenting on cost segregation after Tina's presentation. We're going to get this all wrapped up in an hour. And from a tax perspective, I have my accountant, Frank Costabile, on. So if we get into the weeds a little bit about something that might be more for a CPA or a tax accountant, Frank's going to be here as our guy to kind of catch those questions. So Dave's contact information, Frank's contact information. I will tell you that, as far as Frank's concerned, I will talk to him about very technical real estate strategies, tax strategies, and he doesn't bat an eye. He knows what's going on. Sometimes you don't get that from an accountant. You bring up something like cost segregation and they go, "What are you talking about?" So, but we got to talk about 1031 exchanges. Tina, back to you.
All right, thank you so much, Richard. Hello, everyone. My name is Tina Pashovich, and I am the Regional Sales Executive for Old Republic Exchange. We are a sister company to Old Republic Title, so part of the Old Republic family, and we facilitate 1031 exchanges. So that's our specialty. That's all we do. And today I'm going to give you the Cliff Notes version of a 1031 exchange. So we're going to touch upon the many rules and regulations and talk about the benefits for real estate investors, realtors, etc. So we're going to go ahead and get started. What is a 1031 exchange? Well, it's simply the code designated by the IRS, so Code 1031, which provides that a taxpayer may sell property and defer payment of any capital gains tax if that taxpayer uses the proceeds to acquire a like-kind replacement property. So a couple of terms to pay attention to. The taxpayer is deferring their capital gains tax. So they're kicking the can down the road, so to speak. But you will see that there are substantial benefits to that tax deferment. And then the other term, like kind, that's a very liberal and broad term. Essentially, we are referring to any type of real property held for investment purposes. I'll quickly mention that 1031 exchanges, again, are for investment properties only, not a primary residence. The primary residence exclusion is Code 121, and I'm sure you're all familiar with that. But again, for our conversation and for 1031 exchanges, we are referring to property held for investment purposes. Specifically, the code states that no gain or loss shall be recognized on the exchange of property held for use in a trade or business or for investment if such property is exchanged for property of like kind, which again is to be held for either productive use in a trade, business, or for investment. This is IRS speak for exchanging one investment property for another investment property with the services of a qualified intermediary. That's what we do. We're that necessary middleman in the process of an exchange. And we'll discuss why that is important and why that is a regulation that must be followed. I always like to mention that sometimes when you hear of a tax break, oh, this just must be for that top 1% or that wealthy real estate investor. In fact, 1/3 of all exchanges are for properties less than $500,000. And we often see properties that are below $100,000 that can benefit from a 1031 exchange. So again, this is a tax deferment tool utilized by taxpayers at all levels. Also, exchanges have been around for over 100 years. There was a big birthday in the industry a few years ago. However, the Treasury had updated regulations in 1991, and really not much has changed since then. So those are the Treasury regulations that we abide by to this day. Why do a 1031 exchange? Well, first and foremost, capital gains taxes are fairly substantial. You have to consider your federal rate, which depending on your income is typically 15% or 20%. Then you have to add on your state tax level. And depending on your income, you may need to tack on an additional 3.8% for the Medicare surtax. If you choose to sell and not utilize an exchange, then add 25% for any depreciation recapture. So your capital gains tax figure can oftentimes be a shocking number and fairly substantial. So rather than paying Uncle Sam, if you are interested in investing in additional or more investment properties, then you can leverage that money. Rather than paying the tax, use your own money in essence into a replacement property. So perhaps you can purchase a more expensive property or multiple properties. For example, an investor might own one property for $1 million, and he can exchange that for 10 properties that are each $100,000. And that's a way or a strategy to perhaps gain more rental income. So there's different ways to leverage and strategize when using a 1031 exchange, but ultimately the benefit is that you are using your own money in essence into your replacement property. Another benefit is you can exchange from a passive investment into an income producing property. Perhaps you own vacant land, you're holding onto that to appreciate in value. That's great. Well, you could exchange that for a type of property that is generating rental income, whether it's a single family home, a duplex, or an apartment complex. But again, it gives you that flexibility. And then also it allows the investor to diversify your real estate portfolio. So you are permitted to invest in residential real estate, commercial real estate. It could be a duplex, it could be a hotel. Again, different places to put your real estate investments. Also, you can invest anywhere in the United States and 3 territories, which happen to be Guam, the U.S. Virgin Islands, and the Northern Mariana Islands. But for our purposes, like-kind property is considered anywhere in the United States and those 3 territories that I mentioned.
Tina, I have one question that you answered mostly with
Sure.
that last statement, but is there anything that changes from state to state? I'm selling in Illinois and I'm going to make my investment in Wisconsin, as an example.
It does not. It does not. It's a federal law, so from state to state does not matter.
Okay,
Good
perfect.
question. Yeah.
Perfect.
Yeah, so what qualifies as like kind? Again, it's a very broad and liberal term. You can exchange a single family home as long as it's not your primary residence for a multifamily, or vacant land for a strip mall. Perhaps you want to change up your business a little bit and exchange a hotel for a farm. So the physical characteristics do not need to be identical. You do not need to exchange vacant land for vacant land or residential property for a residential property. Again, any type of property held for investment purposes can qualify as like kind, and again, geographically anywhere in the United States and those select territories.
Hey Tina, one question,
Sure,
and
of course.
I just wanted to glance at that slide. Okay, so Angela asked in the chat, what happens if you purchase a property that is lower than the net money from the initial sale? So there's really 2 issues with that question, because she's thinking the net is the number you're going to look at, which isn't. I'll let you correct that, and then you can follow, finish that.
That's an excellent question, and there's a very important concept in a 1031 exchange, and that is the equal or greater concept. So I will keep the math easy. If you are selling a property for $100,000, in order to defer all of your capital gains tax, you want to roll all of your proceeds into a property or properties equal or greater in value to that sales price. There are certain expenses you can subtract from that sales price, certain customary closing costs, realtor commissions, for example, to kind of knock that figure down a bit. But for conversation's sake, you want to target that sales price. And I get this question often. You know, I'm only making $50,000 profit. Why do I have to purchase a property that's more than $50,000? And again, it's because of that equal or greater concept rule that comes from the IRS. Also, if you have any existing debt on the property, you want to replace any existing debt with equal or greater debt as well on that replacement property. So that was an excellent question. And again, it's very important to understand that equal or greater concept. So
Yeah,
I hope that answers the question.
in one quick thing, it's not about the net as much as it is sales price to sales price. The net's
Correct.
not particularly relevant. If you sold it for 100, the new purchase got to be 120, 150, whatever. So there you go.
Exactly.
Okay.
Exactly. Okay, so we covered like kind. We're going to go ahead and move on. So what are the rules? The IRS does have many rules and regulations that must be followed. The first one, the property sold and the property purchased must be held for investment purposes. I sound like a broken record, but it's so important. I get at least one call a week from a client that is inquiring about exchanging their primary residence. And again, primary residences have their own exclusion. You can exclude up to $250,000 if you file single, and then up to $500,000 if you're filing as a married couple. But again, that's section 121. For our purposes, 1031 exchanges are for properties held for investment purposes. I will mention quickly that flips, I get a question at least once a week also from a house flipper. Flips are considered held primarily for sale, not for investment. So the intent is to purchase that property, get in there really quickly, fix it up, and get it out onto the market. So typically, in most instances, flips do not qualify as property held for investment purposes. So keep that in mind.
Yeah, and Kim asked a good question that we'll follow up with Frank after your presentation about flips, but you addressed some of it right there. Thank you, Tina.
Sure. The second rule, you must use a qualified intermediary. A qualified intermediary offers what is referred to as safe harbor. So a qualified intermediary, that's all we do. A disqualified party would be anyone that's represented the client in the prior 2 years. So it could be an attorney, it could be the CPA, a realtor. Those would be disqualified parties. That's why it's always in your client's best interest to utilize the services of a qualified intermediary, because there is no risk of being a disqualified party. And again, that qualified intermediary is that necessary middleman in the process of exchanging an investment property for another investment property. The third rule, the exchanger may not have actual or constructive receipt of the exchange proceeds during the exchange period, which makes rule number 4 critical to a successful exchange. An exchange agreement must be entered onto in or before the closing date of the relinquished property. The exchange must be set up prior to closing, prior to title transferring, prior to any funds transferring. So if I've sold an investment property, it's closing, it's not even an in-person closing, I have not even laid eyes on a check, I certainly haven't cashed a check. Well, the next morning I decide, I do want to roll all of those proceeds and exchange into another property. Well, at that point, it's too late because I have access to those funds, right? So actual or constructive receipt disqualifies the ability to exchange or to utilize an exchange. So again, critical to set up that exchange prior to closing. We prefer 48-hour notice, but it's not completely out of the ordinary for us to receive a call from the closing table. And more often than not, we can get that set up fairly quickly. But again, the key is has to be set up prior to closing. I don't like to be the bearer of bad news, but I would say at least once a month, I get a call from a potential client who says that they've already closed on their property. So again, it would be too late at that point to utilize an exchange. The fifth rule, the taxpayer must identify in writing potential properties that will be the replacement property in the exchange. This identification must be done within 45 days of closing of that relinquished property. That's a very, very strict deadline, that 45 calendar day identification period. And finally, the sixth rule, the taxpayer must complete the purchase of properly identified properties within 180 days from the closing of that relinquished property. So 45 calendar days to identify, a total of 180 days to close. So we'll take a look at that delayed exchange timeline at 0 days. I have close of the first relinquished property. If you're selling multiple properties and you wish to combine them into one exchange, you can do so. But the timelines start at the close of that first property. You then have that 45 calendar day period to provide written identification of possible replacement properties. Identification is simply writing down the address, signing it, and returning it to the qualified intermediary within that 45-day period. And then you must close on a properly identified property within 180 days. And as you can see, it's not 45 days plus 180 days. It's a total of 180 days. Very strict timelines. These are IRS guidelines. The qualified intermediary is powerless in the Department of granting extensions. And I have heard many sob stories of why they couldn't locate a property, how they couldn't get out to Florida because this or that. And while I do have empathy, again, well, we are powerless in granting any sort of extension. So again, very strict timelines. That 45th day ends at midnight on the 45th day. After the date the exchanger transfers that relinquished property, if you're closing on September 12th, that calculation begins the very next day. Same with that 180th day. So if you're closing on your replacement property and your 180th day happens to fall on a weekend or holiday, you need to be aware of that and close prior to that weekend or holiday. And a good qualified intermediary will, of course, send you your deadline dates. We also send a few reminders, but ultimately it is up to that taxpayer or exchanger to be aware of those dates and comply with those very strict timelines.
So Tina, I got two questions that came up in the chat, and they're similar. So Tawana and
Okay.
Angela want to know, we mentioned that a property that is a flip was never designed for this, but how long does an investor need to hold that investment property for it to qualify for a 1031?
So that is a great question with not a straightforward answer. So the IRS, the IRS coins this, meeting the qualified use period. Well, what is the qualified use period? There's really no magical time period. The IRS looks at your intent at the time you acquire the property. Is your intent to hold for investment purposes? If you have a history of flipping, that's not going to bode well. Having said that, most CPAs recommend a minimum 1 year, 1 day hold period. If it's a vacation home with minimal personal use, then there's a 2-year holding requirement. If it's a related party exchange, there's a 2-year holding requirement. So I hate to be vague, but there is really no magical time period. If we notice that an exchange request has been made and the taxpayer has owned that property for less than a year, we send out this qualified use audit disclosure that, to make them aware that if you're to be audited, you might have to prove your case. You might have to prove your intent, so to speak. So excellent question. Mm-hmm.
You deferred to CPA, I guess, Frank, would that kind of fall in line with your recommendation if a client comes?
Oh, absolutely. I will mention anytime we have a client, we always advise a consultation with their CPA. In particular, for this qualified use, if you've owned a property less than a year, yes, touch base with your CPA. They know more about your tax history and your intent. So
Yeah.
absolutely, 100%.
Oh, Frank, let me know your thoughts if you would unmute yourself and
Yeah, I agree 100% with what Tina just said. It's all about intent. And then from a safe harbor, like what she's saying, 1 year is definitely what we want, especially over two different tax filing years too, like 24 and 25 is the best way to protect yourself from that. But it all comes down to intent. And the intent should also be documented on what your intent is and when you're buying something and what your goals are. And as long as you've got everything documented, that's what's going to stand up, God forbid you get audited. So.
yeah. So Frank, I do have one question since we have you on here, and this might be a little bit too broad, but it was a question that Kim submitted. It said, so if you can't 1031 the home, let's say it's a flip, what's the best way to save on taxes if you're doing a flip?
So the way I look at a flip is it's no different than any other business, whether it's accounting business, a law firm, construction, manufacturer, it's a business, right? So like, what are your goals of the business and what do you want to accomplish? So I would look at it as like you own your own business and what are your goals? Like the number one thing that anyone can do if they own their own business and they have no other employees is fund retirement. Depending on the retirement plan you have set up, if you do a solo 401k, you can put, and again, depending on your age, anywhere from 69,000 to 77,000 into a retirement account and take a tax deduction for that. The other things is, what are your goals, right? Are you looking to do more of these? Do you need to do marketing? Do you need to build some infrastructure, buy equipment and stuff, purchase a car, vehicles? Like, what are your goals, right? Like, are you doing the work yourself, or you need to go buy like a pickup truck where then you can take the section 179 against that if it has a 6-foot bed, we can write that whole thing off. It's like the number one thing whenever you do any of this stuff is setting what your goals are, right? Whenever you go into a project and then helping you achieve your goals. Like, you should never really be looking at how do I not pay taxes? It's like, how do I achieve the goals of what I want to do? And then how do we take advantage of the tax system to help us mitigate paying too much in taxes? So you always need to define what your goals are, and then we can use the tax system to help you achieve your goals. Does that
That's
make sense?
awesome.
Yeah. Okay.
Yeah, no, that's a great perspective. I'm not sure anybody anticipated that. That's why you're my guy. All right, Tina, I'm going to go back to you. So Vishal asked, hopefully I'm getting this right in context, but what if you list a couple properties, they're under contract, can you purchase another or have to purchase the ones that you notified? Okay, so he's stating that it looks like he's listed a couple properties, maybe he executed the agreement identifying some other properties. When can he not update that list of properties they might be targeting? That's how I'm reading his first question.
Okay, so a couple of notes. You can certainly identify and go under contract for a replacement property prior to your relinquished properties going under contract or closing. But of course, we want to make sure that the relinquished property closes prior to that new property. Now, let's say you have provided written identification and we're still within that 45-day identification period. You can make changes, but again, only in that 45-day window. And you would do so by revoking the previous identification and replacing it with another. But again, has to be in that 45-day identification period. And we're beyond that 45 days, you are only permitted to close on a properly identified property. So it has to be a property that you did identify in that 45-day window.
So his next question, I had to read this a couple times, but I get what he's saying now. So if somebody was going to do a 1031, and let's say the relinquished property, as you described it, has a mortgage, and they're buying a larger purchase price than the sales price of the relinquished property, they're rolling all profits in as qualified for the 1031. Instead of getting a mortgage on the new property, can they add cash to that transaction?
Yes, you can bring fresh cash to the table to balance the equity, so to speak. So yes, you certainly can.
Okay, that's an excellent answer, unless you're in the mortgage business. We encourage that you get a mortgage because, you know, you can probably do other things with your cash. So anyway, so
Good.
real quick, Onia asked, and Gail, I'll get to your question in a second, but Onia asked, can I go from residential to commercial? The answer I know that to that is yes, as long as they're both
You
investment.
certainly can. You
Yep.
certainly can. Yes.
All right, go ahead, Tina. I'll let you pick up the slide deck.
Sure. So the benefits, right? You're deferring capital gains tax, which can be fairly significant number. So rather than paying Uncle Sam, take your own money, leverage for wealth building, purchase a more expensive property or multiple properties. There's no limit to the number of times you can exchange, so you can keep going and keep exchanging. It allows you the ability to relocate your assets. So whether it be a class, it could be residential, again, commercial, or geographically anywhere in the United States and those 3 territories. And it's also a great estate tax planning tool. If you have an investment property, you pass away, your heirs receive that on a step-up basis. So at that time, if your heirs sell right away, they would not be required to pay the capital gains tax. If they hold on to that property for, let's say, 5 years and then sell, they'll pay the taxes on those 5 years. So again, it's a great estate planning tool. As a qualified intermediary, what do we do? I'm not going to read all of these, but we are that necessary middleman in the process of an exchange. We handle all of the documents. That includes the exchange agreement, the assignments of the contracts for both the relinquish and replacement properties. We're not permitted to give tax advice. We are not tax advisors. However, we can certainly provide guidance, but we're certainly available to have a conversation, group calls with your tax advisor. We execute the closing documents. Our critical function, or one of our critical functions, is to hold the exchange proceeds to prevent that exchanger from touching the money. And of course, we coordinate with closing agents, real estate agents, tax and legal advisors. Real quick, when selecting a QI, you want to do your due diligence. The last thing you want to do is a Google search. There is a history of fraud in the industry, and there are a handful of good companies out there. You want to look for one, obviously, in compliance and familiar with the code, an experienced company, and a financially secure company. Our parent company, Old Republic International, has close to, this is outdated, $24 billion in assets. You also want to make sure the qualified intermediary has insurance and that they can prove it. Old Republic Exchange has a $50 million emissions policy and a $120 million fidelity bond covering any acts of dishonesty or fraud. That happens to be the highest in the industry, and that's something we have earned due in part to our parent company, Old Republic International. So again, you want to look for a company typically tied to a larger bank or a larger title company. And there's my information. Yeah.
No, go ahead. Sorry.
No, just we have an excellent website, oldrepublicexchange.com. There's a great library of different articles if you want more information on different types of exchanges. We have a great video too, and I do the math calculator if you wanted to punch in some numbers to see what your savings would be by utilizing an exchange. That's kind of an interesting tool to use.
All right, so I have 3 questions, all kind of revolving around primary residence, which is probably pretty common, I would think. So we're going to start with Paul's. What if you turn a primary residence into investment property? Can you do a 1031? And I think it's all about timing, but I'll let you respond to that.
Yeah, so there you can convert once you've met the qualified use period and you want to convert it to your primary. You can do so if you use it as your primary residence, 2 of 5 years of ownership, 2 of those previous 5 years of ownership, then you can use the primary residence exclusion. If it's the opposite way from primary to investment, then there are certain formulas that can be used once you eventually sell the property. So the short answer is yes, but there are some parameters and rules that you must follow.
Got it. So timeline, I decide to rent out my primary residence. Is it 2 years before I can do a 1031 on it? 4 years? Like, let's say I owned it for 10 years. lived in it, I should say.
Well, yeah, Frank might be able to add to this because you do want to live in it for at least a minimum of 5 years and use it as your primary residence those previous 2 of those 5 years in order to
Yeah.
use the primary residence exclusion.
Yeah, I mean, there's inherently, I think there's a lot of like standard deductions that are going to cover most people's appreciation just from keying it off as a primary residence. Go ahead, Frank.
Yeah, I mean, again, you gotta look at what your goals are. I mean, it'd be silly to let the primary exclusion go away of 250 or 500,000 and then have that buried into a 1031 where you could have gotten away with using that exclusion. So you really gotta look and see what the goals are. I mean, I think if the goal was, I did have a primary and let's say, and then there's also another one, even if you haven't been in there in 2 years, if there's a reason why you're moving. I just had someone that's moving to Texas and was only in there a year. Well, you get to do a number of days. So instead of 250, she gets to use 125, which is going to wipe it out. I mean, it all comes down to intent and what the goals are. And you'd really want to use the 250 or the 500 before you think about doing the 1031. I mean, if you're making $1 million, and you're trying to just get out of all the tax, you got to convert it. And again, we'd want to do it over at least 2 calendar tax returns, like in 25 if it was your primary, then in 26 we'd want it as a rental. Do you know what I'm saying? So we can show that then we're going to do it as a rental because it has to go from an investment property to another investment property to do the 1031. But it's not an easy answer to the question that's asked.
Yeah, I kind of figured that. So Tina, how often can you do a 1031? And I think Donna's asking it. So you got an investor that's got 20 properties. Like, can they use, if they all qualify, can they do 1031s this year if they want?
Absolutely. There's no limit to the
Okay.
number of exchanges. So
Perfect.
yeah, absolutely. And we see
Bill?
that. We have clients that have numerous properties and 20 exchanges a year. So yes, absolutely.
Okay. Bill asks, what are your fees? That might be a loaded question, but what are your fees?
Yeah. So we have a small sliding scale, but roughly a standard delayed exchange will cost anywhere between 1,500 and 2,000, and that seems to be the going rate for most QIs.
Okay.
And that
Perfect.
includes the sale and purchase.
Perfect. All right. I didn't intentionally put this off for Gail, but I want to read this question because she approached me yesterday when I was out at their office. I'm going to read this and you got to bear with me. I think I know the intent, but I want to, it's in the Q&A. So I have a current seller who told me that they're selling their primary residence and buying a new primary residence out of state. He sold 2 investment properties, which he is using the proceeds plus the sale along with the proceeds from his primary. The new primary can be purchased with funds for the new home, I guess. And as long as they were told by somebody, as long as they rent their new primary out for 11 days a year, that would qualify under some new law that would make that investment property.
So I'll let Frank chime in after I attempt this answer, but I'm going to say that is not permitted. Now, what you can do at times is carve out, let's say you purchase a duplex and half of it's your primary and you rent out, or you carve out a guest house portion, then you may be able to exchange into the guest house portion. But as far as having a primary residence and simply renting it out for any number of days, that would not qualify if I'm following the question correctly.
Frank, did you want to opine on that as well?
Yeah, I've never heard of that. So I mean, I would have to do some research, but yeah, I can't imagine that. They may be getting that confused with the Augusta rule, where you're allowed to rent your primary residence for 14 days and not pick up any of the income. I don't know what the confusion with that is, but there's no law that I'm aware of that just came out. There hasn't been any laws that have come out recently because Congress hasn't been able, they've been so divided. There hasn't been any really new laws in the last 4 to 6 years that have come out. So
perfect. Okay. All right. One last questions as it relates to this, and then we're going to jump into the second section with Dave, and we will get all these questions answered. But So, Tina, if somebody were to sell a commercial property and then turn that, take the proceeds, 1031 into a residential property, they rent that property out for 2 years, but then they convert it to a primary residence. When is there some sort of tax obligation, if ever, relative to we went from a 1031 where we took the profits, we bought a rental, and now it became a primary residence? When is there, it seems to me that there's going to be a bill due somewhere along the way. When would that happen?
Well, again, Frank's gonna have to jump in, but once you, for the primary residence exclusion, again, they would have to make it their primary for 2 of the previous 5. So you're saying this was investment to primary? Did I follow that correctly? And then
Yeah,
what
we
happens
went
down
from
the
an
road? Yeah,
investment
yeah,
to investment. So,
yep, to primary, yeah.
and then converted it
So,
to primary. No sale, just
right.
converted it to primary.
Right. They would have to hold on to it, Frank, correct me, a minimum of 5 years to utilize the primary residence exclusion once they sell it.
And then the question for Frank would be, are the profits from the initial still deferred, or erased is not a great word, I'm sure, with the IRS, but forgiven, whatever word you want to do. How would that work, Frank?
Yeah, that I would have to do some research on. I know that happens. I know it comes up in a lot of our CPEs because that is way that people try to get around from paying taxes, going from an investment to the residential. I know that the number of days comes into play, like with what Tina said. I can't speak that it's 5 years or 2 years. I'd actually have to do the research on that. That's way too specific of a question
Okay.
to answer it
All right.
in this forum. So.
All right, I appreciate that. Tina, if you can give us our share back. I think you have to
You
disconnect that.
got it.
And then, so Dave Mitchell has been a friend and a resource of mine for a long time. Dave is with Engineered Tax Services. David actually presented something to me that I truthfully was not aware of, but something that could save you and or your investors a lot of money in a short amount of time. So I'm really happy to have Dave here to talk about cost segregation. David, the floor is yours. And you're muted.
Sorry about that. Rich, I
That's
appreciate
okay.
the opportunity to present to the group and educate a little bit about cost segregation. I think what you'll see is it's a tool or strategy that can be used for real estate investors to offer some immediate cash flow and reduce their tax liabilities, as well as just maximize their investments. It's not a new solution or new tool. It's been around since the 1940s. You'll see if you're on TikTok or YouTube, there's tons of new cost segregation experts. It seems like every day posting videos. We've been doing this for over 20 years. We're a national leader and we have a national reach. So wherever the properties are located in the US, we can help on that. And we're not a CPA firm. We rely on firms like Frank's to help with their clients with the utilization of the results that we bring. So just to give you a general overview of what cost segregation is it's basically an engineering study of the building. And what that allows you to do after you've done the study is change the depreciation schedule for that building. So typically, if you haven't done cost segregation, you use something called straight line depreciation, which is either 27 and a half years for residential properties or 39 years for commercial properties. And even residential short-term rental properties, that's considered 39 years or commercial. With doing cost segregation, the analysis that we do, we reclassify or redistribute certain assets of the building into personal property. The reason you do that is the IRS understands that not everything in the building is going to last for 27 years. you're going to replace the flooring, cabinets, counters, things like that. So they allow you to use faster depreciation schedules for some of that property. If you look at the diagram here, with straight line depreciation, the whole building is looked at as one asset. So everything inside of it, the landscaping, it's depreciated evenly over either 27 and a half or 39 years. You get a fixed amount each year that you can write off as a depreciation expense. If you do cost segregation, you change your depreciation method, and now you've got the ability to depreciate certain assets over 5 years, over 15 years, and then the remaining structural components stay in that 27 and a half or 39-year life. Why does it make sense to do this? The most obvious reason is with the accelerated depreciation, you're able to reduce your taxable income so that you lower your tax payments. You could also significantly increase your cash flow upfront. In essence, what you're doing is you're taking a little bit of future years depreciation and front loading that into the current year. So you've got a larger write-off that you can use in the current tax year. You're still going to get depreciation write-offs like you would. It's just a lower percentage. And I've got an example I'll show in a couple slides. One of the big things that happened with the Tax Cut and Jobs Act in 2017 is something called bonus depreciation. And this was a component that added a huge benefit to cost segregation. What it did was allowed anything that we're able to reclassify into those 5 or 15-year buckets, you could take that full amount in the first year. So, typically about 30 to 35% of let's say a single family house, rental house, about 30 to 35% can be reclassified into that faster depreciation. So with bonus depreciation, it allowed you to use that full amount in the first year. Unfortunately, there was a sunsetting in that where it dropped by 20% each year starting in 2023. So any, let's say a rental house that was purchased in 2023, you'd get 80% of the bonus depreciation. So you could use 80% of that in 2024 for your 2023 taxes. In 2024, purchases are placed in service. It dropped to 60%. This year, it's 40% until it phases out in 27. There's still a huge benefit to getting that 5 and 15-year reclassification. It's just bonus depreciation was basically cost segregation on steroids. The good news is for the past 3 years, there's been a concerted effort to bring back 100% bonus depreciation. It passed through the House last year, then stalled out in the Senate. A few other tax bills were grouped onto it. Then the election was coming up, so nobody wanted to make a stand. It's definitely part of the new administration's tax policy, and we're thinking sometime in July, August is when we'll see some movement on that. We don't know if it's going to be retroactive so that you can go back if you had a purchase in 2023, which would normally be 80%. We don't know if it's going to be retroactive where you can get that extra 20% right away, or if it's just going to be forward looking. But we're confident that it's going to come back to 100% bonus depreciation at some point.
Hey, Dave, we got a question in the chat on here. Does this work with individual condo units?
Absolutely. Any type of property that's a rental property, so an investment property, it does not work on primary residences, but anything that shows up on your tax return would work with cost segregation. Condos are great. We've got a lot of short-term rental owners that have condos that we do cost segregation studies on, and they provide really good results as well. Any other questions?
No, keep going, my friend.
Okay. So what types of buildings or situations are a good fit for cost segregation? New construction. If you're building an investment property, and that's really the best time is either right at the acquisition or the construction, because then we've got a base to show what the building looked like at purchase or at construction. And that way, if you do renovations in the future, you can deduct the property or assets that you're taking out of that building through a process called partial asset disposition. So that way you don't have to carry the old assets as well as the new renovated assets on the depreciation schedule. You can immediately expense what the, let's say, for example, a ceiling fan that you took out, or you've redone the roof. Your CPA can write that off the old asset that was taken out. Existing properties. So I get this question all the time, we've owned it for 2 years, is it too late? Not at all. We can go back and do look back studies. So typically, obviously, it depends on the building itself and the value of it, but typically 10 or 15 years, we can go back and still bring some substantial benefit to that building. Leasehold improvements, if it's on the commercial side and somebody has a tenant that's putting money into the build out, those also work, as well as a step up in basis, like Tina had mentioned. If there's an inheritance, if there's a partnership where the other partner sold their stake in the building and now you've got an additional investment in that, you can use cost segregation to help with that situation as well. 1031 exchanges, like Tina said, that what's nice is this can be a companion to 1031 exchanges. I've got clients that will do cost segregation on the new building that they've 1031'd into, and then that just allows them to utilize those tax deductions for the previous tax year as well. And then also, if you're selling a property with large capital gain, you can use the cost segregation deductions to help offset that as well.
Hey, David, you answered this timely, as a matter of fact, but Vishal and Tamika said, they asked the question, like, it doesn't matter if they've owned the property for 5 years, 7 years, they could still come back to you. It doesn't have to be done in the first year of ownership of the property. You confirm that anytime they can come to you and start working on the segregation process, correct?
Absolutely. And it's a pretty straightforward process where there's just an additional form that's filed, a 3115 change in accounting form. And what that does is it basically reconciles the previous deductions that have been taken and brings forward and compares that to what you would have been eligible for with cost segregation. And then that balance is used in the current tax year. So you don't have to go and amend previous returns. It's a pretty straightforward process.
Good deal. Let's get into this chart. This looks awesome.
Yeah, so there's some misconceptions about cost segregation where, it only works or is only beneficial if it's $1 million house or, an office building. About 48% of our work is with residential investment properties. This was an example of a client that I just finished up the study on in March of this year for their 2024 tax return. It's a $192,000 house that they purchased back in June of 23. To get the depreciation basis, you basically take the purchase or construction price and then back out the land value, since you can't depreciate land. And that gives you the depreciation basis, which is what we calculate all of the accelerated depreciation off of. So if you look at the box on the left, that's what we brought to them through cost segregation compared to what they would have gotten without cost segregation. And it shows, the first year there's a big jump in the benefit. And then you'll see going forward, even in future years, they're still going to get a depreciation write-off. We're just taking a portion from those future years and front loading it into the first 5 years. So in this specific example, $192,000 purchase, he was able to write off $46,000 in deductions to lower his taxable income by that amount. So it was still beneficial, even though it wasn't, a multi-million-dollar house.
So somebody, ultimately, if somebody does just as a real world example, and I think this is what you're referring to in the last slide, if you've got some folks on here who are flipping properties, they have a couple of flips, but then they've got something that they can, so now they've got some potential capital gains that they're looking at. And again, this might be a question for Frank and Dave, but a couple of flips in 24, they're like, oh boy, I'm going to have some big tax obligations. But I've got these other properties that I could maybe forward some depreciation and write off. They might want to seek you to save some money in taxes. Would that be an accurate statement?
The only thing I'll say is that with flips, it's typically not a good candidate for cost segregation.
No. I didn't mean it. I meant that they own they did a couple flips,
Yep.
but they also own some property that they're maintaining.
Yeah,
So
absolutely.
yeah, so
Yeah,
they can use those properties they're maintaining, put them into a cost segregation, get the depreciation, apply that to the capital gains. And again, it might be more of a Frank question, but I'm just thinking for the folks that are flipping, a lot of people that flip also retain property as well.
correct.
So would that be an accurate way to reduce your taxes, Frank?
Maybe.
Uh,
Yeah, the main thing is, again, it's all intent, you know what I'm saying? So like, what I was saying before with the flipping, if that's like a real business, you know what I'm saying, then it's not passive, where passive losses have to be offset against passive income. So you can't offset passive losses with a cost seg. If that creates a big loss, that loss could, unless you're under one, there's a lot of rules if you're under 150, but that can only be offset against other passive income strategies. But if you're active and you're flipping and that's an active business, then you wouldn't be able to offset passive losses with active income.
okay.
But
Yeah, it's really
if it's
really
not,
a kind of a case by case basis that you
yeah,
definitely
exactly.
want to speak with your accountant and CPA with, because like Frank says, these are considered passive write-offs, which can be applied to your passive income, so the income from the rentals. However, there's some qualifications, like if you're considered a real estate professional status, which means you spend 750 hours a year managing the properties, those types of things, then it can be used on your W-2 income as well. There's also a rule for short-term rentals with material participation rules that allows you to lower that to 100 hours. So definitely speak and consult with your CPA on your specific tax situation.
Okay. All right. I'll let you keep going too, because I want to get through your deck here and get one or two other questions in. Oh,
Good
the
time.
last
That was
slide.
the end of it.
Ta-da!
I'll just say that, for anyone on this call that owns commercial or rental properties, or if if you've got clients that are active in investment real estate, I'd love the opportunity to put together a free analysis for their properties where we can show what the potential tax write-offs would be, what our fees would be to do the study. I also work with a lot of real estate agents where if they've got a listing and they know it's going to be a rental property, so maybe it's a duplex or multifamily, I can run preliminary numbers on the property with just basic property information, address, selling price, square footage, those types of things. And they've actually used that information with their listing to showcase what the potential tax savings is on this investment opportunity.
Perfect. All right. So a couple other questions. These are random, but I think this one's probably be directed to Frank. My CPA, this is from Greg. My CPA says that I can only write off repairs or improvements after a property has put into service, quote unquote, advertised for rent.
I mean, that with any business, you have to start the business before you can take any write-offs. So that's like with any business. I mean, that's an accurate statement, right? You have to be renting, but I mean, like, that doesn't mean you have to have a renter, right? It means that you have to be in the process of going to rent it, right? So like, let's say you market it to be rented January 1st and you don't get it rented till, or let's say a better example, let's say you market to rent it October 1st, but it doesn't get rented till January 1st. Well, you'd be able to write those off if you were actively, treating it as a business.
Got
But
it.
you have to have a business. See, the business has to be up and running. So I
that
don't know if there's
makes sense.
miscommunication between that, but the business has to be up and running. Doesn't mean it has to have a renter, but you have to be operating, you know what I'm saying, as if it would
Yeah, you.
be a business.
So if you're doing a buy, fix, and hold, and it won't be available to January, you just got to market it for rent in 24 as an example, and then you could write it off for that year.
Correct. Yep.
Cool. Okay, that was a good question and a good example too, by the way. This one I know is for Tina, and or maybe Frank. So Jill asks, how do we know when a 1031 makes sense?
Well, you know, your first question is, do you want to continue to invest in real estate? So, you know, there's management responsibilities, et cetera, when dealing with investment property. So if you have one and you're selling it, that's your first question. Do you want to reinvest into investment properties? Second, you want to find out what your capital gains tax looks like if you do not use an exchange. So actually, that should be your first step. Consult with your CPA, find out what your adjusted basis is, and see what that tax looks like. So when you combine what the tax ramifications look like, along with what lifestyle you would like moving forward, whether or not you want management responsibilities with rental properties, et cetera, it's kind of a balance. So again, I think those are two important considerations.
That's awesome. Well, I'm going to start tying this up in a bow for everybody. So first things first, I want to let you guys know that we do quite a bit of financing for investors. Not only cash flow programs where we don't require tax returns from our investors to make their life a little bit easier. We're simply qualifying the buyer of the investment property purely on the rents coming in, but there's also access to fix and flip money and some other products. So if you are working with investors, we do have access to a lot of tools, including some commercial lending as well. We've seen a lot of six flats come across our desk and been able to take great care of those. Our next class is live. We're so excited. We are going to actually be in the Moore offices May 22nd, and the topic is going to be renovation. We are going to have Jose Valdivinos, our in-house renovation expert there, and we're going to do the same class for those of you on the south side at Moore's office in Tinley Park, June 11th. So our next virtual meeting will be June 17th, and that's going to be on social media and artificial intelligence, how to help you guys out. I wanted to thank again Lori, who again had some things she had to take care of. Tina, of course, great. If you guys are thinking 1031 exchange and you want a reputable company, I don't know why you wouldn't consider ORT or Old Republic Exchange, ORE for you guys. And then certainly David has been doing the cost segregation thing for a while. You know, at least it's something for you agents to talk to your investors about. If they don't know this tax tactic, then you guys look like a hero if you can save them a lot of money. And I don't know if you could tell, but Frank is very, very well versed in tax law. I enjoy working, well, I kind of enjoy working with him. Him and I have a good relationship. So anyway, he's a great guy, super knowledgeable. If you're looking for a CPA who gets this stuff, reach out to Frank. You guys will get contacts for all of these folks. And again, if you're working with investors, I too am an investor, so I speak the language. I look forward to working with them. Thank you guys all. Thanks to speakers. Thanks to the agents who've been here. And we appreciate you. And last but not least, Tony, for making it all happen. None of this happens without her. So thank you, Tony.
Thank you.
Everybody's saying thank you. We'll let the chat roll a little bit as people go. So, Vishal, you're welcome. I think I got your stuff covered. Marie, that's awesome. Thank you guys. Tony's got the grinning emoji. Love that. So, all right, guys. You guys have a good one. Thank you guys for everything. Take care.